full year depreciation in the year of the asset purchase and none in the year of disposal. So in that case, we're given information about an asset which was disposed. And there are two, I think, two adjustments we are going to make in relation to that, because we are told that this item of plant was sold for 20 million. Now, this 20 million, we are told, is included within the revenue. So it is obvious that once the company sells an asset, the amount received from the sale of asset, this should not be treated as part of the revenue, should not be treated as part of what? Of the sales. And therefore, this amount of 20 million, this amount of 20 million, which was received from the disposal of the plant, 20 million, this one will be deducted from the revenue. This one will be deducted from the company's what? Revenue, because you are told this 20 million was included within the revenue. It was credited in the revenue account. It's also important for you to note, if you go to the requirement, to the trial balance, it is important for you to note that trial balance which you're given, if you check on the figures up there, you'll be able to see that those figures are in thousands of shillings. So therefore, for us to be consistent, we must work with all our figures in thousands of shillings. In any of the figure we have from the additional information, we must omit the last three zeros. We must omit the last three zeros. Yes, we must omit the last three zeros, the last three zeros. Yes, I'm trying to make some changes on my camera here. I don't think it is that clear, but it should be now. It should be now. It should be clear now. Should be clear. Should be clear. Yes, it should be clear. Should be clear. Okay. So therefore, what you have said is that this particular amount, we will deduct it from the revenue. Number two, anytime the company sells an asset, disposes an asset, you must compute whether the asset was, you must determine whether the asset was sold at a gain or at a loss. And actually, we do that by preparing an account which is called the disposal account. So therefore, what we need to do is basically to prepare the disposal account, and we determine whether this asset was disposed at a gain or at a loss. Although in this case, let's not use the disposal account. Let's not use this account. Let's just compute this directly. To compute the gain, or basically the loss on disposal of an asset, we take the sales proceeds. The sales proceeds, our asset was sold at how much? And then we deduct the net book value, which is the same with the carrying amount. We know that the net book value of an asset, this one is equal to the cost minus the accumulated depreciation. So if you get, after taking this minus this, if you get a positive figure is a gain, but if you get a negative figure here, if you get a negative figure is what? Is a loss. So therefore, let's compute this. We will take the sales proceeds, and basically the sales proceeds is this particular amount at which our asset was sold at, 20 million. And then to that, we proceed and we less the net book value. So the net book value, we are saying, is the cost minus accumulated depreciation. If you check on the information we have in paragraph, in note number one, sentence 2, we are told no accounting entries was made. The plant had a cost. We are given the cost. I want us to compute this one. We take the cost, which is 39,700,000. That was the cost, and accumulated depreciation of 15,860,000. So this now will give us the net book value. So therefore, we take 20,000 minus this net book value. So how much would be our net book value here? How much would be our net book value? The net book value for this item. So that would be 39,700 minus 15,860. So what are you getting? I'm getting a figure of 23,840. Is that what you're getting? Lucia, Helen, is that what you're getting? Hassan, Virginia, Raphael, is that what you're getting? Yes. So it basically means that this particular asset here was sold then at a loss, because if we take this minus this, we will get negative what? We'll get negative 840, which basically is a loss on disposal. So being a loss on disposal, this one will be included within the cost of sales. within the cost of sales. It will be added to the cost of sales. It will be added to the cost of sales. So I think those is what is required. One, we have said this amount of 20 million, which was included within the sale. We will less that from the sales. Also, in this case, we have computed the loss on disposal, which you have said will be added to the cost of sales. So let's move to note number 2. And you're told the depreciation on property, plant, and equipment is to be provided and allocated as follows. So we are given the 4 assets: buildings, plant, motor vehicle, office equipment. We are given the rate for computing the depreciation, the basis of computing the depreciation, and how that depreciation will be classified. So let's compute those particular depreciations for the current year. That should be our working number 2. Depreciation. So we start by computing the depreciation on buildings. Depreciation on buildings. In this case, we are told this will be 2.5%. Using which method? Using the straight line. So you have to recall, under the straight line method, we compute the depreciation based on cost. Under the reducing balance method, we compute depreciation based on the net book value. So therefore, for building, we will take 2.5% of the cost. What is the cost of the buildings? The cost of the buildings, this one, you should get it in the trial balance. The first item within the trial balance, we have property. And property we know comprises of land and building. This is something I said in our previous class. Property comprises of land and building. So in this case, we are told the cost of buildings is 400 million. It automatically means that because the total cost of the property is 600 million, the cost of land is 200 million. But in our case, we're interested with this. We're interested with the cost of the building. So the cost of the building in this case is 400,000. Remember, we are working with all our figures in thousands of shillings. In any figure, we are omitting the last 3 zeros. So let's get 2.5% of that. 2.5% of this will give us what? 2.5% of this. What are you getting? What are you getting here? Are you getting 10,000? Yes, 10,000. That is the figure I'm getting from Helen. That is the figure I'm getting from Lucia. Okay. So then from there, basically, even before we proceed to compute the other depreciation, we are told that this depreciation here of 10,000, this one would be classified as part of the administrative expenses. So let's move and compute the depreciation on plant, which will be 10%. 10%. Which method is used here? The reducing balance method. So under the reducing balance method, we compute depreciation based on the net book value, So we need to compute the net book value of the plant. How do we compute the net book value? So we will take the cost, because this one is equal to the cost minus the accumulated depreciation. So therefore, the net book value of the plant will be equal to the cost. The cost is given in the trial balance. Can you see the cost? The cost is the second item within the trial balance, which is 280,000 minus the accumulated depreciation, which is down there. The accumulated depreciation, who can be able to see the accumulated depreciation on plant? It is 111, 160. 111, 160. So this will give us what? 280,000 minus 111, 160. And what are you getting here? Yes, I'm getting a figure of 168,840. Is that what you're getting? Please confirm. Hassan, are you getting this? Noor, are you getting this? Is that what you're getting? Is that what you're getting? Please confirm so that we move. Is that what you're getting? Yes. So we have 168,840. But now you have to remember, in the additional information number 1, there was a plant which was disposed. Can you remember this plant which was disposed? I want us to go back to note number 1. We see what we are told. Specifically, the last sentence of note 1. In the last sentence of note 1, we are told it is the company's policy to provide for the full year depreciation in the year of the asset purchase. What does that mean? It basically means that once the company has purchased an asset in a given year, the company will provide a full year depreciation. Even if the asset is bought 2 months, 1 month, or even 3 months to the end of the year, the company provides a full year depreciation. That's what you're told. And none in the year of disposal. And none in the year of disposal. So if an asset is purchased in course of the year, no depreciation for that asset. And therefore, I hope you can be able to recall, during the current financial year, the company disposed this plant. And we are told whenever an asset has been disposed in a year, no depreciation to be provided in that year. So this net book value here comprises the net book value of this plant which was disposed. So what we need to do, before we compute the depreciation, we need to eliminate the net book value of this plant which was disposed. The net book value of this plant which was disposed is basically what we have computed here. Remember the net book value. This is the net book value of the plant which was disposed. So therefore, we left it here. We left 23,840. So why are we doing that? Because as per note number 1, the last sentence, we are told no depreciation in the year of the asset disposal. So if an asset is disposed in course of a certain year, no depreciation to be provided in that year. Sasa? Yes. So this now will give us what? We take this one minus this, minus 23,840, which will give us 145,000, and then we get 10% of that. So 10% of that will give us what? Will give us 14,500. And then this depreciation here then will be classified as part of the cost of sales. Will be classified as part of the cost of sales. Will be classified as part of the cost of sales. Will be classified as part of the cost of sales. Is that point clear? Have we understood where we have done that? Zipporah, Lucia, Helen, Noor. Is that point clear? Is that point well understood? If it is well understood, let's move and compute the depreciation for the other asset. So we are still in note number 2. Let's compute the depreciation on motor vehicles. Motor vehicles, which is equal to 20% of what? 20% on street train. Street train, we compute the depreciation based on the cost. What is the cost of motor vehicles? Motor vehicles, basically, this is that item within the trial balance, which is 70,000, and this will give us 14,000. So how should this depreciation be classified? As per note number 2, this one will be considered as part of the distribution costs. So we also compute the depreciation as per note number 2 on office equipment, which will be 12.5%. 12.5% of the costs, because the method to be used there is the street train. So the office equipment, the cost for that is 40,000. 40,000. So what would be 12.5% of this? 12.5% of this. This will give us what? Is it 5,000? 5,000. Yes, 5,000. And basically, this one still will be part of the administrative expenses. Part of the administrative expenses. So we are done with that point. I want us now we move to point number 3. In point number 3, we are told it is discovered that the former financial controller of BD Limited engaged in fraudulent financial reporting of shillings 12 million of the trade receivables. Okay, let's take that point again. We are told it has been discovered that the former financial controller of BD Limited engaged in fraudulent financial reporting. Shillings 12 million of the trade receivables are non-existent and need to be written off. Of this amount, 7 million relates to the year which ended 31st of December 2022, which is now the current year, while the balance or with the balance relating to the prior period. So basically, we are told in that point, the former financial controller of this company was involved in fraudulent financial reporting. Fraudulent financial reporting, in very simple terms, we refer to this as cooking the books of account. If, for example, as an accountant, you want to show the company is financially stable, you may overstate the assets. You may overstate the assets, or basically you can overstate the revenue. So that's what the financial controller did. So within the trade receivables, he included 12 million, which is non-existent. So no debtors who owe the company an amount of 12 million. And we are told this amount has to be written off. That amount has to be written off. So the working three here will be the trade receivables. The trade receivables, which are to be written off. So the trade receivables to be written off basically is an amount of 12 million. So we are told 7 million of these related to the current year. And basically this one will be treated as an expense, will be recognized as an expense within the current year. Remember, what we said is that when preparing a statement of profit or loss for publication purpose, we classify the expenses into 5. Now, this particular amount which was written off, we have to determine it will be classified as part of which expenses. Is it part of the cost of sales? Is it part of the distribution, admin, finance, or other expenses? Now, because this particular amount has been written off as a result of a decision made by the management of the company, this one we included within the administrative expenses. It is an amount which has been written off as a result of administrative decision, as a result of decision made by the management. So this one will be added within the administrative expenses. And then the other amount, which is 5,000, which relate to the previous year, this one will be adjusted in the retained earnings, when preparing the statement of changes in equity. Statement of changes in what? In equity. If you can be able to recall, in our previous class, I gave you the format for preparing this statement of changes in equity. We said any prior year adjustment. These are adjustments which were supposed to be done in the previous year, but they were not done. They should be adjusted to the retained earnings at the start. Because this was this amount of 5 million was supposed to be recognized or was supposed to be accounted for by the company as an expense in the previous year, but it was not accounted for. So this one we will deduct it from the retained earnings of the company at the start. This one we treat it as an administrative expense, and then the full amount, this one of 12, this one automatically will be deducted from the trade receivables. The trade receivables of the company will be reduced with what? Will be reduced with the 12 million. So that is the adjustment which is required for that amount. So let's move to the other note. Let's move to the other note. We move to the other note, we see what we are told. Note number 4. Note number 4 is all about IAS 12, income taxes. And we are told the existing debit balance on the current tax in the trial balance represent other stroke over provision for previous year's tax. Can we first of all go back to the trial balance? In the trial balance, I can see we have something called the current tax. Can you see the current tax? And actually, we are told that that current tax is a debit balance. So how much is the current tax in the trial balance? The current tax in the trial balance is how much? Current tax in the trial balance. Current tax in the trial balance, can you see that? Current tax in the trial balance. Yes, so I'm told that current tax in the trial balance is an amount of 2,600. 2,600. Now, take into account this amount in the trial balance, it appears on the debit column. What is this? Is it over or under provision? What is this? Based on our previous discussion, is it under or over provision of tax? Over or under? I'm told by Zipporah it is under, by Lucia it is under. Yes, automatically this one is under provision. is under provision. We said if that amount appear on the debit column of the trial balance, it is under provision. If it is appearing on the credit side, we said is what? Is over provision. We said such under provision in the previous year should be brought to the current financial year and should be added to the current year's estimated tax liability. So in the other sentence of note number 4, we are told a provision for current tax for the year which ended 31st of December 2022 over 52 million is required together with a decrease in deferred tax provision of 3 million. So basically what we need to do here is first of all, we compute the amount of current tax, which will be taken to the income statement. And we say to compute this one, we take the estimated tax liability for the current year, which you're told is 52 million, and then we adjust this with the overall under provision of current tax from the previous year. Remember, in the previous year, there was under provision, which we should add to this. So to this, we should add what? 26. And basically now that will give us what? That will give us a total amount of 54,600. So this is basically what we will recognize in the income statement or in the statement of profit or loss as the current tax, Still in the same point, we are told there was a decrease in deferred tax provision. There was a decrease in the deferred tax provision of 3 million. So how do we account for this? A decrease in deferred tax. How do we account for this? Who can be able to recall? Because what we said is that during the current year, what we account for in the income statement as far as the deferred tax is concerned is the increase or the decrease in deferred tax liability. So we are told there is a decrease in the deferred tax liability. So we say this one should be accounted for as what? In the income statement. Who can be able to recall? Zipporah, we said this one should be recognized as what? In the income statement. Remember the other question which we did, we had an increase in deferred tax liability. We accounted for that as a deferred tax. Actually, we had a decrease. I can remember. We had a decrease and we accounted for that as a deferred tax income. So the same case, because there's a decrease in deferred tax liability, this one in the income statement, will be recognized there as a deferred tax income. So we are done with that. Let's move to the other point. Number 5, we are told the inventory count as at 31st of December 2022 revealed the value of the inventory at cost was 85 million. So this is a crossing inventory, no working which is required. In note number 6, we are told on 30th of December 2022, the company directors invited the current shareholders to subscribe for a right issue on the basis of 1 share for every 5 shares which were held at an exercise price of 15. So this is information about the right issue. And then you're told the come right price. The come right price is the market price per share before the right issue. The come right price on the last day of trading was shillings 20. And then you're told the proceeds from the fully subscribed right issue was credited in the suspense account. So basically in that case, we are told there was a right issue. And I hope you can be able to recall we said a right issue. This is the issue of additional shares to the existing shareholders of the company at a price below the market price. So what we need to do here is we compute how many shares were issued by the company during the right issue. And as per note number 6, we are told during this particular right issue, the company was to issue 1 share for every 5 shares which were held. So the company was to issue 1 share for every 5 shares which were held. So what we need to do is to determine how many shares were held before the right issue. So we take the ordinary share capital of the company. The ordinary share capital that should be around the 4th item or the 5th item from the bottom of the trial balance, which is 200,000. We want to know the shares which had been issued by the company before the right issue, we take the ordinary share capital. For us to be able to determine the shares, we divide that with the par value per share. The par value per share in that case is 10. So this will give us 20,000 shares. So these are the shares which were held before the right issue. So we need to determine how many shares were issued during the right issue, because the company was to issue 1 share for every 5 shares which were held. The shares which were held were 20,000. So we cross multiply, then we divide. So we have 1 times 20,000 divided that with 5. So this will give us the shares which were issued by the company during the right issue. So, and this will give us, is it 4,000 shares? 4,000 shares, is that what you're getting? 4,000 shares. Please confirm whether you're getting that figure. Is that what you're getting? 4,000 shares? Yes, 4,000 shares. And as per note number 6, these shares we are told they were issued at a price of what? They were issued at a price of 15. Remember, during the right issue, the shares are always issued at a price below the market price. So the amount which was raised from the right issue was 4,000 times this, which was 60,000. And we are told in note number 6, this amount was credited in the suspense. You see, anytime the company has issued share, the amount which is received, that amount is always debited in the bank account. This amount is debited in the bank account, and basically should be credited in the ordinary share capital. Part of it should be credited in the share premium. I'll be able to explain what we credit here, what we credit here. A total amount of what? Of 60. But instead of the company crediting these two accounts, the company credited the suspense account. And that's why in the trial balance, the last item, I hope you can see a suspense account, and the amount credited there was 60. So that this amount of 60 was credited here instead of being credited in the share capital and the share what? Premium. So we need to do the correct accounting entry, or to effect the correct accounting entry. And this amount of 60,000, we are saying it was supposed to be credited in 2 accounts: ordinary share capital and the share premium. Now, the amount which we credit in this account is always based on the par value per share. So we take the shares which were issued, which were 4,000, and then we know the shares were issued at 15. The amount which we credit in this account is always based on this amount here, the par value, not the issue price, but the par value, the amount which we have in the trial balance, the par value of 10. So the amount which is credited in the share capital is always based on the par. So therefore, the amount which was supposed to be credited in that account is 40,000. The amount which was supposed to be credited in this account, or the amount you're going to credit in this account, is equal to the shares which were issued times the amount of the share premium. The amount of the share premium is basically the amount which is above this 10 shillings. Remember, the shares were issued at a price of 15. How much is the amount is above 10? The amount above 10 is 5. So that one is a share premium. So an amount of how much? An amount of 20. So therefore, in preparing our statement of changes in equity, this will be added to the share capital. This one will be added to the share what? To the share premium. To the share what? Premium. And basically, in our case, I think we are done. So what we need to do now is basically proceed and prepare what is required. So we start with part A. So we have the title. The name of the company is BD Limited. And this is the statement of profit or loss. Statement of profit or loss, which is for the year, which ended 31st of December 2022. 31st of December 2022. 31st of December 2022. So here we need to have just a single column like that. We just need to have a single column. So have this so that we move together. Yes, so I want us we prepare this together. I hope you already have the title with you. I hope you already have the title with you. And what do we start with here? Who can be able to remind us? Zipporah, what do we start with here? In preparing the statement of profit or loss, we start with what? We start with what? We start with the revenue. We start with the revenue. So the revenue, that one is always given in the trial balance. That one is given within the trial balance, So revenue, how much is the revenue? You have to recall the revenue will have to be adjusted because this amount which was received from the sale of the asset was included within the revenue. So once the company sell an asset, that is not considered as part of the sales. So the revenue I'm told here is an amount of how much? Is an amount of 1123,500. 1123,500. So to this we less this amount of 20,000, which was included within the revenue, and this will give us an amount of how much? This will give us 1103,500. 1103,500. Is that what you're getting? Is that what you're getting? If yes, please confirm. Please confirm. Are you getting that? Yes. So having that, we need to move and we compute the cost of sales. You have to recall, how do we compute the cost of sales? Cost of sales, this one is equal to opening inventory plus purchases minus closing inventory plus depreciations plus the loss on disposal. Because in our case, we are not given the cost of our sales. We have to compute that. So this cost of sales, we go back to the trial balance, and below the accumulated depreciations, we have the opening inventory. So the opening inventory is an amount of 138,000. To that we add purchases. Purchases is below that opening inventory, which is an amount of 667,000. 667,000. And then to that we less the closing inventory. I hope you can remember closing inventory is in note number 5. Note number 5. So we less 85,000. We less 85,000. And then to this we add various depreciations. So from these depreciations which are computed in working 2, some depreciation should be included as part of the cost of sales. One of it is this depreciation on plant, which is 14,500. Do we have any other? This part of admin, this part of distribution, this part of admin. Yes. So no any other depreciation. And then finally, we add the loss on disposal. I hope you can remember, here we have a loss on disposal, which we said will be included as part of the cost of sales, this one. So we add 38,40. So that is how we compute the cost of sales, which we take to the last column, So this will give us what? 138,000 plus 67,000 minus 85,000 plus 14,500 plus 38,40. And I'm getting a figure of what here? I'm getting a figure of 738, 340. 340. Is that what you're getting? Are you getting that? If yes, please confirm. Yes. So that is confirmed by Zipporah. Are you getting the same? Are you getting the same? Helen, Lucia, Raphael, are you getting the same? So if you're getting the same, we need to move and we compute the gross profit. The gross profit should be the difference between those two values. Give me the gross profit. How much is the gross profit? The gross profit I'm getting 365. 160. 365, 160. So to this then we proceed. Please confirm whether you're getting those figures. Are you getting those figures? Are you getting those figures? Yes. So then to this we proceed, we add other incomes. Remember, we say that when checking for the other incomes within the trial balance, we check the items appearing on the credit side. So in the trial balance on the credit side, which incomes do we have? So I think on the credit side, I can see accumulated depreciations. Those are not incomes. Down there, I can see revenue, trade payables, bank balance, deferred tax, and the bank balance. And then on the other side, I can see share capital, share premium, retained profit, and suspense. So in that case, we don't have any other income. We don't have any other income. So to this, then we proceed and we less now the expenses. Maybe first of all, we can get the total incomes. There is 65,160. So we less the expenses. Remember, this is our total incomes. So for the expenses, we can start with the distribution cost. The distribution cost. The distribution cost, we take the amount given in the trial balance. And the distribution cost is given below the purchases. I hope you can see that, which is an amount of 44,000. That is the distribution cost, which is given within the trial balance. Given within the trial balance. Given within the trial balance. And I hope my video is clear from your side. Or is it fluctuating? I can see some information on my screen that my internet may not be stable. Helen, Raphael, Zipporah, is my video clear from your side? Is my video clear from your side? Okay, so if it is clear, then let's continue. So now to this distribution, we need to add certain depreciations. So like this depreciation on motor vehicle will be included here. Will be included there. Then this one is admin, this one is admin. Okay, so we get the final figure, which is 58,000. 58,000. Then from there we proceed and we take into account the administrative expenses. So the administrative expenses, we take the amount given in the trial balance, which is below distribution cost, and that is that 93,500. So to this, we first of all include this depreciation on buildings, 10,000. The depreciation on office equipment, 5,000. 5,000. And then there is something else to be included here, and that is this amount of 7,000, the trade receivables which were written off. So we also add 7,000. 7,000. I don't think we have any other adjustments. So then we get the final figure. We get the final figure. We get the final figure. So we have 93,500 plus 10,000 plus 12,000. Plus 12,000. I'm getting a figure of 115,500. 115,500. 115,500. 115,500. Is that what you're getting? 115,500. Yes, that is confirmed by Zipporah. That is confirmed by Zipporah there. So then from there, we need to record the other expense, which is basically the finance cost. Now, for the finance costs here, I think what we have is the bank interest. Just like the other question which we did, we have the bank interest. And that bank interest, we said we consider it here as part of the finance cost. And that is an amount of 2,400. 2,400. Then from there, we will proceed and we check whether we have any other expense. We check whether we have any other expense which is not included within the cost of sales within distribution, admin, or finance cost. Maybe we can check that from the trial balance. Remember, you said all expenses in the trial balance, they have a debit balance. So let's check the items in the trial balance or appearing on the debit column. So up there, we have property, plant, motor vehicle, office equipment. All those are assets. Down there, I can see we have inventory, purchases, distribution, admin. We have dealt with those. Down there, I can see we have receivables, current tax, bank interest, and then interim dividends. So basically, none of those are the expenses. And then from the workings which we have done here, we have dealt with this. We have dealt with all these depreciations. We have dealt with this. this income tax will be adjusted to the profit before tax. These are a right issue. It basically means that in our case, we don't have any other expense. We don't have any other expense. So what we need to do now is we get the profit before tax. We get the profit before tax, basically by taking the total incomes minus those three expenses. So 365,160 minus 58,000 minus 115, 500. Minus 2,400. Yes, what are you getting here? What are you getting here? I'm given a 62 to 60 by Lucia. Lucia, is that correct? 189 to 60. 189 to 60. 189 to 60. That is the same amount I'm getting there. Lucia, please confirm your figure. Yes, now to this we proceed and we make adjustment for income tax expense. Income tax expense. Now remember, you say that this income tax expense, this one basically comprises of two values or two components of taxes. It comprises of the current tax, which we computed here, and the deferred tax. So let's first of all we consider this one. the current tax, and the current tax is this amount which we computed here, this one, which is 50,4,600. And then also this one comprises of the deferred tax. And what we have here is the deferred tax income. So the deferred tax income, that one should be added here. And it's basically an amount of 3,000. So because it's an income, we add it to our profit. We add it to the profit here, and basically we get the profit for the year. The profit for the year, or basically the profit after tax. The profit for the year or the profit after tax. Yes, so that will be how much? Minus 54,600 plus 3,000. Plus 3,000. That is coming to 137,660. 660. That is what I'm getting, yes. So then to this, we said we proceed and we add the other comprehensive incomes. These other comprehensive incomes include the gain or loss, the revaluation gain or loss on things like PP. If you check on this question here, we don't have any revaluation gain or loss on what? PP. So meaning that the total comprehensive incomes remain 137,660. It remains 137,660. So that's what was required in part A of that question, and the marks which were allocated there were 6. So these are basically the items which will give you those 6 marks. So that and that, the expenses, our 3 expenses, basically the tax like that. So let's move to part B, and we are required to prepare the statement of changes in equity. The statement of changes in equity. So remember, a statement of changes in equity, this one is prepared basically to show the changes in the various items of equity. And therefore, we said in preparing this statement of changes in equity, we always start with the details column. And then we need to go back to the trial balance which are given. We see which items of equity was this company having in this year. So we have various items of equity. Actually, we said equity comprises of share capital and reserves. So the first item of equity, I can see ordinary share capital. Below ordinary share capital, I can see share premium. Maybe you can just write that in full. And then from there, we have the retained profit. The retained profit, the retained profit. Do you have any other component of equity? Any other component of equity? I don't think so. I don't think so. And then finally, we have the total column. It's also important for us to indicate here that our figures will be in thousands of shillings. Our figures will be in thousands of shillings. So what do we start with here? We always start with the opening balances. We start with the balances brought down. The balances brought down, these are the balances we have in the trial balance. The balances we have in the trial balance. The balances we have in the balances we have in the trial balance. 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 Someone is saying my board, Modimo's board is not clear. Is my board clear? So please confirm that as we continue. So we record the opening balances. So for the share capital, this is 200,000. Share premium is 50,000. Retained earnings is 223. 640. 640. 640. Yes. I think the internet, I think it is fluctuating. I don't know what is happening, but I don't think it is that bad. So let's get the totals. Let's get the totals. We have 250 plus 223. 223, 640. 640, which will give us 473. 640, 473, 640. Then what do we need to do? We need to record the various items or the various transactions which occurred during the current year, and basically which affect these items of equity. Maybe you can start with what? Let's start with what we have here. This statement of profit or loss which I have prepared. We said what we bring here is the profit after tax. The profit after tax, this one, or the profit for the year. And actually that one should be taken to this column, the retained profit or the retained earnings column. And then we take it to the last column, 137, 660. Then from there, we have this right issue. This right issue. And basically the right issue, we have said it will affect two items. We're going to add 40,000 to the ordinary share capital, 40,000, and then to the share premium, we add 20 there. The total amount is 60. We take it to the last column there. We take it to the last column there, Okay, so then from there, this will not affect that. We have this particular amount here of 5,000, which we said will be deducted from the retained earnings at the start. And actually this one, we refer to it as the prior year adjustment. The prior year adjustment. This was an item which was supposed to be adjusted in the financial statement for the previous year, but it was not adjusted. So this one will be deducted from this because this was supposed to be, or this 5,000 was supposed to be recognized as an expense in the previous year, but it was not accounted for. So the profit of the previous year was overstated. So that's why we are deducting that from the retained profit from the previous year. Sasa? Yes. So we refer to it as the prior year adjustment. So let's check whether we have any other adjustment we need to capture there. This one will not affect that. The same case with this, but if we go back to the trial balance, I think there is somewhere I saw interim dividends. Yes, we have interim dividends. The second item from the bottom of the trial balance, we have interim dividends. Interim dividends. Interim dividends, we said dividends are always paid from the profit. So we left those dividends here, which is an amount of 10,000. and we take it to the last column. We take it to the last column. So I don't think we have anything else. I don't think we have anything else. So let's get now the balances at the end of the year, which then we transfer to our statement of our financial position. So ordinary share capital, this will be 240,000. 240, this one will be 70,000. So we need to get the closing balance in the retained earnings or the retained profit, 223,640 plus 137, 660 minus 15,000. So what are you getting here? I'm getting 346,300. So then we need to get, is that what you're getting? Yes, that is confirmed. So let's get the total in the last column. The total in the last column, you may decide to add this plus this plus this, or you work out that downward. You should get the same value. You should get the same value. I'm getting 656,300. 656,300. Okay, yes. So that is it. That what was required in that question, and equally the marks allocated there were for those. These are basically the items which are marked: the opening balances, profit after tax, the right issue, interim dividend, and the prior year adjustment. Remember, the totals are not marked here. These totals are not marked. The same case with those totals. So we go to part C, where we are required to prepare the statement of financial position, a statement of financial position, statement of financial position. So here we start by recording the non-current assets. We start by recording the non-current assets, non-current assets. So for the non-current asset, remember, we always start by recording the tangible non-current asset. Tangible non-current asset in our question here, we basically have a number of them, including property, plant, motor vehicle, office equipment. But in this case, if you can be able to recall, we said when preparing a statement of financial position for publication purpose, we don't record those particular assets yet separately. So instead, compute the total net book value and basically include them here under the name of the property, plant, and equipment. So that's basically what we need to do. So here we will have the property, plant, and basically what? Equipment. So we will start with the first asset within the trial balance. The first asset within the trial balance is property. So property comprises of land and buildings. So we will take the cost, which is 600,000. First of all, I will deduct. Remember, we say that to compute the net book value of an asset at the end, you take its cost at the start minus the accumulated depreciation, which is in the trial balance. The accumulated depreciation in the trial balance, this is the accumulated depreciation at the start. And because you are not interested with the net book value at the start, to this also we have to less the depreciation for the current year. The depreciation for the current year is what we computed in working two. In working what? To depreciation for the current what? Year. Yes. So to this, we will less the accumulated depreciation at the start. Remember, this is the property which comprises of land and buildings. The accumulated depreciation at the start in the trial balance is 80. And then we also less the depreciation for the current year, which is this one, 10,000. That is basically for property. That is for what? For property. Then to this, I will add the net book value for plant. And for plant, in this case, we must recall that there was a plant which was disposed. So therefore, in terms of how we are going to compute the net book value for the plant, that one will be quite different. That one will be quite different because this plant which was disposed, do we need to include it here? Who can tell us? The plant which was disposed, should it be included here? Helen, Zipporah, should we include it here? The plant which was disposed, yes or no? Do we include it here? Once an asset is sold, do we include that asset here? Yes or no? Automatically no. So therefore, in terms of how we are going to compute the net book value for plant is quite different. So what we will do, we had computation, that computation here. This amount here, this was the net book value for the plant at the start. But in this case, we proceeded and we deducted the net book value of the plant which was disposed. And in that case, after taking this minus this, I can remember we had a figure of 145,000. So this 145,000 is the net book value of the plant at the start of the year. And that does not include the net book value of the plant which was disposed. So therefore, to compute the net book value of the plant at the end, I will take 145. This is the net book value of the plant at the start, excluding the plant which was disposed. And then because this is the net book value at the start, this amount of 145, I will have to less the depreciation for the current year only. The depreciation for the current year only for plant is how much? Is 14,500. So to this, I will less 14,500. So remember this now for plant. This for plant. This for plant. You can see the computation for that is quite different because of the plant which was disposed. Then let's move and compute the net book value for the other asset, which is motor vehicles. So to this, we will add motor vehicles. We need to compute the net book value for motor vehicles. The computation would be the same here. We take the cost of motor vehicles at the start, 70,000, minus the accumulated depreciation at the start, which is given in the trial balance, 42,000, minus the depreciation for the current year, this one, 14,000. So this is how we compute the net book value for motor vehicles at the end. So to this, we add the net book value for office equipment. For office equipment, I'll do the same. I'll take the cost, which is 40,000. I will less the accumulated depreciation at the start in the trial balance, 15,000. I will also less the depreciation for the current year, which is 5,000. Which is 5,000. So this now will give us the net book value for the plant, for the office equipment at the end. And then I'll get the final figure, which will be the net book value for all tangible and current assets. So that will give us what? Maybe we can start with the property. So this 600,000 minus 90. 600,000 minus 90,000. And basically that should give us what? That should give us 510. What about plant? We take 145 minus 14.5, which will give us 130.5. What about motor vehicles? Motor vehicles, we have 70 minus 40 minus 14. I'm getting 16. And then office equipment, I have 40 minus 20. 40 minus 20, which will give us 20. So we add all these net book values. 510 plus 130.5 plus 16 plus 20. And this is the final figure I'm getting, 676,500. So confirm whether that is what you're getting. Confirm whether that is the figure you are getting. Are you getting that figure there? Are you getting that figure? That is confirmed by Helen. Okay. That is the total net value for all property, plant, and equipment, for all tangible and current assets. Then from there, we need to check, do we have any other non-current assets, things like investment, things like goodwill, things like investment property? I don't think we have any. I don't think we have any. So from there, let's proceed and record the current assets. We proceed and we record the current assets. So for the current asset, we need the trial balance. We check the asset on the debit column. So we have dealt with all those items which are up there. Then down there, you can see we have inventory at the start. Remember, you said what we record here is the closing inventory, the inventory at the end. Then below that, we have purchases, distribution, admin. In fact, we have dealt with all those items. But down there, you can see we have the trade receivables. The trade receivables amount is 74.5. So someone may ask, which amount is the receivables, which amount is payables? So it is obvious that receivables, trade receivables is an asset. All assets have a debit balance. Trade payable is a liability. It should be the one on the credit side. So, but now to this amount of receivables, remember, we said that there is this amount of 12 million, which we say should be deducted here. So from to this, we less 12 million. That will give us 62, 5 what? 62,500. Okay, so then below receivables, we have bank balance. It is also important for you to see that that bank balance is on which side of the trial balance? The bank balance. The bank balance is on which side of the trial balance? The debit or the credit? The bank balance. The bank balance is on the credit side. Being on the credit side, this is what? This is a bank overdraft. So being a bank overdraft, it will be a current liability. So then from there we have deferred tax, current tax, bank interest, ordinary, share premium, retained, interim, suspense. And then in the additional information, I think you have dealt with additional information number 1, 2, 3, 4. But if we go to the additional information number 5, we have the closing inventory. Closing inventory, we recognize it here as a current asset. And that is an amount of 85 million. Yes, note number 6 is about right issue. So meaning that we don't have any other assets. So we get the total assets, the total assets. So we add whatever you have here to the current assets. So, and in this case, I'm getting a figure of 824,000. 824. Confirm whether that is what you're getting. Yes, that is confirmed by Helen. I've not gotten any answer from Raphael. Raphael, are we together? Virginia, are we together? Rusia, tuko pamoja? Yes, so once you get your answer, type it in the chat box so that I know whether we are together or not. Okay, so we move and now record items of equity. And for items of equity, remember, we have these figures here. So where do we get these figures? From this statement of changes in equity. So the first item is ordinary share capital. Ordinary share capital. So the ordinary share capital, this is now what we bring here to 40,000. So then from there we have share premium. Share premium, which is 70,000. Share premium 70,000. And then from there we have the retained profit. We have the retained profit. So the retained profit is 346,300. And then we get the total equity. The total equity, which is 656,300. 656,300. Yes. So that's basically what we have as our total equity. So we need to move and basically record now the liabilities. So for the liabilities, we start with the non-current liabilities. We start with the non-current liabilities. Non-current liabilities. Non-current liabilities. So for the non-current liabilities, remember, we start by, or actually here, the non-current liabilities. We say that this one may take the form of bank loan, may take the form of debentures, may also take the form of what? Of deferred tax. And I think in our case here, we just have one, just like the other question. We don't have bank loan, we don't have debentures, we only have deferred tax. We have the deferred tax. Now, this deferred tax, there is a deferred tax which you're given in the trial balance. The deferred tax given in the trial balance is how much? The deferred tax in the trial balance, which is below the bank overdraft. Who can see this figure there? The deferred tax, you can see the figure. The figure is how much for deferred tax? Is 32,400. But it's important to note that that deferred tax is the deferred tax at the start. That was we said even in the other question. But now what you have to recall is the information which are given in note number 4. In note number 4, we were told that during the current year, there was a decrease in deferred tax. So therefore, to compute the deferred tax at the end of the year, we will take the deferred tax at the start, 32,400. And then we are told this reduced during the current year with how much? 3,000. So this one reduced with 3,000. So we deduct 3,000. So this will give us 29,400. So 29,400 is basically the deferred tax at the end of what? Of the year. That is the deferred tax at the end of what? Of the year. We don't record the deferred tax at the start, but basically we record the deferred tax at the end of what? At the end of the year there. So we don't have any other non-current liability. We proceed and finally record what? The current liabilities. The current liabilities. So for the current liabilities, I think we have a number of them, and equally it's also important for you to recall that all liabilities have a credit balance within the trial balance. So we check the items on the credit side. So I can see depreciations down, depreciations. Then I can see revenue. Below revenue, I can see trade payables. I can see trade payables. Trade payables is an amount of 68,800. So and then below that, I can see the bank balance. But in this case, specifically, we can refer to that as a bank overdraft. So in most of the cases, the examiner will not tell you that that is an overdraft. That's why you are told it's just a bank balance. Majority of the students will come and record that here as an asset. So that's why you can see the examiner has not specified that that is a bank overdraft. But anytime you're given a bank balance on the credit side, that is always a bank overdraft. But if it was on the debit side, automatically is an asset here. So we have that bank balance. Then below that, I can see deferred tax. Basically, I've dealt with that. Then on the credit side still, I can see those items of equity. Ordinary share capital share premium, we have dealt with all those. What about in the additional information? In the additional information, we have dealt with the note number 1, 2, note 3. But now note 4, we have the current tax. The current tax. Remember, we said what we recognize here is the estimated tax liability. Estimated tax liability for the current year before adjusting it with overall and a provision. In note number 4, sentence 2, we are told a provision for current tax for the current year was 52. So that is what we recognize here before adjusting it with overall. And so I've not recorded the bank overdraft here. And the bank overdraft is the 15,500. So I think we are done with the note 4, 5, and 6. Yes. So basically we are through. So what we need to do is to get the total equity and liabilities. Yes. So December 2020, the total equity and liabilities. Total equity and liabilities. Total equity and liabilities. Financial position as at 31st of October 2023 and 2022. So we have the non-current assets, which include property, plant, and equipment. We have intangible assets. Below that, we have current assets, trade receivables, cash and cash equivalents. Then at the equity, we have ordinary share capital, revaluation surplus, retained earnings. Then you have the total equity. We have the non-current liabilities, which include long-term borrowing, deferred tax, and then we have the current liabilities, which include trade payables, current tax, interest payable, and then we have the total equity and liabilities. Then we have the statement of comprehensive income, where you have revenue, cost of sales, gross profit, distribution cost, admin expenses, profit from operation, finance cost, profit before tax. We have the income tax expense profit for the year, And then we have other comprehensive income, which include revaluation gain on property, and which is net of deferred tax. Then we have some additional information, number 1 up to note number 3. We are going to go through that particular information. And then what are we required to do? We are required to prepare a statement of cash flows for Budo Limited for the year which ended 31st of October 2023 using an indirect approach in accordance with International Accounting Standard number 7. So before we prepare a statement of cash flows, I want us to go through the additional information and we see, and there are some workings which are required. So let's go through the additional information, starting from the additional information number 1, where we are told that property, plant, and equipment was made up as follows. So we are given the information about property, plant, and equipment, whereby we are given the values on 31st of October 2023, and actually that is the end of the current year, and then 31st of October 2022. 31st of October 2022 is the end of the previous year, and it's also important to note that the closing balance for previous year are the opening balances for the current year. So those figures we have for the year which ended 31st of October 2022, this will be the opening balance for the current year. So we have the costs or valuation, that should be cost or valuation. We have the accumulated depreciation, and then we have the carrying amount. Now the carrying amount, this is the same with the net book value, and basically this is the value at which now the assets or the PPE are recorded in the statement of financial position. In fact, if we go up there in our statement of financial position, specifically under the non-current asset, you will see we have the PPE, property, plant, and equipment. The value at the start of there was 113,600. At the end of there, it was 118,400. And basically, those are the figures we have in note 1 as the carrying amount. Then, in the second sentence of note 1, we are told, during the year which ended 31st of October 2023, the property was revalued upward for a gain of 1.2. So basically, that is a revaluation gain. So, and we know a revaluation gain, this one is debited in the PP account, and then we credit that in an account called the revaluation reserve. Then you're told the company does not make any transfer to for excess depreciation upon review. However, it accounts for deferred tax on revaluation gain. The income tax rate applicable to Budo Limited is 30%, and then you're told the depreciation for property, plant, and equipment has been charged to the profit and loss. I think what we need to do as far as that information in paragraph 2 is given. Number 1 is to compute something called the deferred tax on the revaluation gain. So, and this, I think, something which is covered in the topic of income taxes. So let's compute the deferred tax. The deferred tax on revaluation gain. So how do we compute this one? So to compute this, we take the revaluation gain, and then we multiply this with the tax rate. So in paragraph 2 of that particular question, we are told that this particular company revalued a property upward with an amount of 1.2. Remember, if you go back to the income statement, the statement of financial position given at paragraph 1, you will see all figures are in thousands of shillings. In thousands of shillings means that the last 3 zeros have been omitted. So therefore, for us, we also need to be consistent here by also working with all figures in thousands of shillings. So any figure you are picking from the additional information, you have to omit the last 3 zeros. So like this figure, we will not take it as 1.2, but we take it as 1,200. But we know we have omitted the last 3 zeros. Still, in paragraph 2 of note 1, we are given the tax rate, which is 30%. So therefore, this deferred tax on revaluation gain will be an amount of how much? Will be an amount of 360. Now, how do we account for this deferred tax on the revaluation gain? So in terms of how we account for this amount here, that is the revaluation, the deferred tax on the revaluation gain, this one we debit it in the account called the revaluation reserve account. We debit this in an account called revaluation reserve account, and then we credit we credit the deferred tax account. We credit the deferred tax what? The deferred tax account. In other terms, this particular amount of deferred tax on the revaluation gain, this one should reduce the revaluation gain. For example, this revaluation gain, when it is being recorded in the income statement at the other comprehensive income, because this should be recognized as part of other comprehensive income, the company will record this, but minus tax. So this will give us 840. So if you go back to the income statement which was prepared by this company, the income statement which was prepared by this company, I hope you can see that below the statement of financial position. Down there, below the profit for the year, I hope you can see the profit in the statement of comprehensive income. I hope you can see we have other comprehensive income, and where we are given the revaluation gain on property. Revaluation gain on property is this revaluation gain, but the amount which is recorded there is 840. And actually, you can see inside the bracket, we are told it is net of deferred tax. So which deferred tax? This one. So therefore, in terms and the financial statement prepared by the partnership business at the end of the year, or in other terms, the final accounts to be prepared by partnership business at the end of the year. Also, partners prepare something called the statement of financial position. Statement of financial position. So these are basically the final accounts which are prepared by the partners in a partnership business. So therefore, in this case, we're going to look on how we prepare these final accounts of the partnership. Account and the appropriation account, statement of profit or loss, and appropriation account. So as the name suggests, this one is basically prepared to ascertain the performance of a partnership business at the end of the year. So in other terms, we prepare this one to determine whether a partnership business operated at a profit or basically at what? At a profit or at a loss. So is there any difference in terms of how we prepare these statement of profit or loss in case of a company, in case of sole proprietorship, and also in case of partnership? No much difference. So it's only that in case of a partnership business, so once we have gotten the profit for the year, or basically the net profit for the year, we have to proceed and prepare something called the appropriation account. So this appropriation account basically is prepared to determine, or basically to show how the profit which was reported by the partnership business will basically be distributed to partners. Will be distributed to partners, or in other terms, how that particular profit for the year will be shared among partners, among partners. So therefore, to prepare this, we start with the revenue. Just like what we are doing in case of sole proprietorship, in case of a company, revenue is also known as the sales. And to this, we less the sales return, which we also know is known as the return inwards. And basically, we get the net sales. We get the net sales, and then to this we less the cost of sales. So the computation of the cost of sales remain the same. I hope you can be able to recall how we were computing this. We were taking the opening inventory plus purchases minus return outwards plus carriage inwards minus the closing inventory. The computation of that is the same, just like what we're doing in case of partnership, in case of a company, and also in case of a sole proprietorship. So then from there we get the gross profit, So after getting this gross profit, we basically proceed and we add the other incomes. We proceed and we add other incomes. We add other incomes. So the other incomes to be added here include things like discount received, the rent received, the decrease in provision or allowance for doubtful debt, and so on. And then we get the total incomes, the total incomes, and then to this we proceed and we less the expenses, just the normal expenses, things like depreciation of assets, the salaries, and things like the rent and electricity, and so on and so on. The normal expenses, we let them here, and basically we get now the profit for the year. The profit for the year. So after getting this particular profit for the year, in case of okay, so what are we told here? What are we told? The question is, Maria and Bakari are in partnership, sharing profit and losses in the ratio of 3 all over 5 for Maria and 2 all over 5 for Bakari. The partnership did provide for the interest on capital at the rate of 5% per annum. The partners are entitled to annual salaries of 1 million and 700,000 for Maria and Bakari respectively. The following balances were extracted from the books. We are told the following balances were extracted from the books of partnership as at 30th of April 2016. So we have the capital account, the current account inventory as at 1st May 2015, buildings at cost, furniture at cost, renovation of building, sales, purchases. And then we have rent and rates. We have electricity, we have bank balances, account payable, account receivable, repair and maintenance, general expenses, insurance carried inward, budget written off, salary and wages, office expenses, provision for depreciation on furniture on 1st May 2015. We have cash balances, we have drawings for Maria and Bakari. Then we have additional information number 1 up to number 6. And from that information, what are we required to do? We are required to prepare the income statement for the year which ended 30th April 2016, 12 months. And also we are required to prepare the statement of financial position as at 30th of April 2016. So automatically, even before we prepare what is required, we must, first of all, go through the additional information we see. Is there any working which is required? So therefore, we go through the additional information as we check whether there is any working which we need to do. So in note number 1, additional information number 1, I hope you are there. We are told inventory as at 30th of April 2016 was valued at 15.6. No working for that. That is a closing inventory. Number 2, we are told depreciation is to be provided for as follows. Building 2.5% on cost and furniture 10% per annum on reducing balance. So we need to compute those depreciation. So our first working here would be to compute the depreciation. And in this case, we start by computing the depreciation on buildings. The depreciation on buildings in this case would be 2.5%. Which method? Or basically, we are told per 2.5% per annum on cost. What is the cost of buildings? So if we go back to the trial balance, up there we have capital, current account, inventory, and then below that we have the cost of buildings, which is 8,500. I hope you can see that being the cost of the building. But down the building, I hope you can also see we have furniture, and then I hope you can also we have something called the renovation of a building. So a renovation of a building, basically, this is a cost which is incurred by the company in renovating a building. So how do we account for that renovation cost? Now, this renovation cost, this one is supposed to be capitalized. This one is supposed to be what? Is supposed to be capitalized. So what do you mean by capitalizing an expense or capitalizing a cost? So this renovation cost will be considered to be part of the cost of the building. So if you have renovated a building, so the cost you have incurred, you should add it to the cost of your buildings. You should add it to the cost of your building. But this one, renovation cost, this one should not be recognized as an expense in the income statement. In other terms, renovation cost, this is a capital expenditure. This is a capital what? Expenditure. I don't know whether we discussed this when we were looking on the earlier adjustment, but I think I mentioned something to do with that. There are those particular expenses which are incurred by the company and which are not supposed to be taken to the income statement, but rather they are supposed to be capitalized. A good example is the renovation cost. This one should not be taken to the income statement as an expense, but this one should be considered as part of the asset. So therefore, to determine the cost of the buildings, we will take the cost which you are given below the inventory at the start, which is 85, and then now to this we add the renovation cost. The renovation cost, which is 1,500. So meaning that the cost of the building will be 10,000. Will be 10,000. So this renovation cost will be added to the cost of the building. Will be added to the cost of what? Of the building. Is that clear? Is that clear? Is that clear, Evans? So once you have renovated a building, because these are costs you're incurring once, you add it to the cost of the building. You can't take that to the income statement. So the expenses which we take to the income statement are the expenses connected with the operation of the business. Once we renovate a building, this is not an expense connected with the running of the business. This is not like electricity. This is not like salaries. This is an expense which just incurred once. You add it to the cost of the building. So therefore, this one would be 10,000. And basically, this will give us what? This will give us 25. It will give us 25. Is that coming to 2,500? Please confirm 2,500. Are you getting 2,500? 2,500? 2,500? Yes, 2,500. So then from there we move and compute depreciation for the other asset, which is the furniture. Furniture will be equal to 10%. The method which is used here is the reducing balance. The reducing balance, we compute the depreciation. We compute the depreciation based on the net book value. What will be the net book value for furniture? The net book value, remember, is equal to the cost minus the accumulated depreciation. So the cost of furniture, which is below our buildings, is 32, and then still within the trial balance down there, down in the trial balance, we have something called the provision for depreciation. So that provision for depreciation on furniture, this is another name for accumulated depreciation. So the accumulated depreciation can also be known as what? Provision for depreciation. So therefore, the accumulated depreciation on furniture is 750. So we get the net book value, and then we get 10%. So this will give us what? 32 minus 750, which will give us 245. Okay, so we are done with that. And then number 3, we are told the following amounts were owing as at 30th of April 2016. We have salaries and wages and electricity. I think we don't need to have any working for this. Remember, you said any expense which is outstanding or any expense which is owing is an expense not yet paid at the end of the year. This one we said 1, we add it to the expense already paid, and number 2, we account for it as a current liability. We account for that as a current liability. I'm told this one is 250. I'm told that one is 250. Okay, that one is 250. So therefore, no working which is required as far as number 3 is concerned. So those expenses which were owing, we add them to the expenses already paid, to the expenses in the trial balance, and then we treat them as a current liability. Number 4, allowance for doubtful debts amounting to 200,000 is to be made. So what we need to do here is basically to determine whether we have an increase or decrease in allowance for doubtful debts. So number 2, we have allowance for doubtful debts. For doubtful debts, which was created at the end of the year. For doubtful debts. So the ones which was created at the end of the year as per note number 4 is 200,000. Remember, this is a provision at the end. So what we need to do is basically we compare this with the provision at the start, and then we see, do we have an increase or a decrease? So can we go back to the trial balance? You tell me, do we have any provision or allowance for doubtful debt in the trial balance? In the trial balance which you are given, do we have any provision or allowance for doubtful debt, Esther? We don't have any. So meaning that at the start of the year, the provision for doubtful debts was 0, but now it is increasing to 200. So meaning that this 200 basically is an increase. And remember, you say that an increase in provision for doubtful debts, an increase in allowance for doubtful debt, that one is what? Is an expense in the income statement. So this one will be accounted for as an expense in the income statement. When preparing the statement of financial position, we will also list this one from receivables. We are done with that. Number 5, insurance paid in advance at the end of the year amounted to 40,000. No working for that, but this insurance paid in advance, we are going to list it from the amount already paid. And number 2, we account for it as a current asset. Number 6, which is the last additional information here. So during the year, which ended 30th of April 2016, the partners withdrew goods from the stock for personal use as follows. Now, these are the goods which were taken by the partners from the partnership business. So these particular drawings by partners, the drawings of goods, and basically which are given in the additional information. In the additional information, it is important for you to note that these particular drawings for goods, they have not yet been accounted for. We said anything which you're given in the trial balance has not yet been accounted for. So because if we go back to the trial balance, the last item within the trial balance, we have drawings by Maria and Bakari. Now, these drawings which we have in note number 6, they have not yet been accounted for. They are not part of the drawings given in what? In the trial balance. And therefore, these drawings of goods given in the additional information, which will be total drawings of 150 for Maria, and for Bakari, 590, which basically give us a total of 740. This one will be deducted from the goods available for sale. The goods available for sale. Anytime you go to your business, you take what? You take goods for your personal use. That reduces the goods available for sale. It reduces the goods available for sale. And number 2, these particular drawings, other than being deducted from the goods available for sale, they will also be added to the drawings. They will also be added to the drawings which are given in the trial balance. They will also be added to the drawings given in what? In the trial balance. So that basically will be the accounting treatment of those particular drawings. So, and I think now having that, we can proceed and basically prepare what is being required there. I want us to start with the part A, preparing the income statement. And we need to have the title. The name of the partnership will be Maria and Bakari. Maria and Bakari partnership. This is the income statement. The income statement, and automatically we have to add the appropriation account. We have to add the appropriation account, and basically this is for the year which ended 30th of April 2016. 30th of April 2016. 30th of April 2016. Yes, so here we need to have two columns. We need to have two columns, and I hope you can also be able to see the figures which are given in the trial balance. They are in thousands of shillings. So in thousands of shillings means that for any figure which is given in the trial balance, the last 3 zeros have been omitted. So therefore we said for you to be consistent, anytime you're taking a figure from the additional information, you must also omit the last 3 zeros. So let's prepare this. So we start with the sales. The sales. So where do we have the sales? The sales, we have it within the trial balance. Below where we have the renovation of building, which is given as 87,460. So to this we less the sales return, or basically the return inwards. So we need to check whether we have the sales return. Do we have sales return or return inwards? Do we have sales return or return inwards within our question here? In our trial balance? In our trial balance, I can't see sales return. I can't see any sales return or return inward. So mean that our net sales will be that amount. Then we proceed. We compute the cost of sales. The cost of sales. So the cost of sales, this one is computed in the normal way. We take the opening inventory. The opening inventory, this one, we have it within the trial balance. I can see it up there below current account and capital account. I hope you can see that amount, which is 19,000. So to this, we add purchases. We add purchases. So purchases, that is below our sales, and that is an amount of 62 and 40. 62 and 40. To this, we less purchases returns, or the return inward, return outwards, and I don't think we have this one. We don't have purchases return or return outwards. To this, we add carriage inwards. We add carriage inwards, and I think we have carriage inwards. So how much is our carriage inwards? Carriage inwards. Is it 960? Yes, carriage inwards, which is 960. 960 there. Yes. So the other item which we also deduct here is something we didn't came across in the topic of sole proprietorship, these drawings of goods. And the drawings for goods which we list here is very, very important for you to note. The drawings for goods or the drawings of goods which we list here should be the drawings for goods which are given as part of the additional information. As part of the additional information. So these drawings of goods given in the additional information, they have not yet been accounted for, not the drawings within the trial balance. If the drawings in the trial balance were drawings for goods, they have already been deducted from the purchases figure. But what you list here are the drawings for goods given in the additional information. Are we together? Yes, that one you must understand it. You must understand that. So the drawings for goods, we have said is 150 plus this one, which will give us 740. So we list that here. We list that there. And basically now we will get the goods available for what? For sale. We will get the goods available for sale. We will get the goods available for sale. So how much will be our goods available for sale here? What are you getting? 25 units. If Marimu's computation is automatically not correct. Not correct. Yes, what are you getting, guys? What are you getting? We try to hurry up. We must finish this particular question today. 83, 160. 83, 160. So to this, then we proceed. We list the crossing inventory. So the crossing inventory, this one, is given in the additional information number 1. Additional information number 1, 15, 600. 15,600, yes. So let's get the cost of sales, which we take now to the last column. I'm getting 65, 760. Is that what you're getting? Is that what you're getting? Is that what you're getting? Yes. So then we get the gross profit. We get the gross profit. So the gross profit in our case here will be, I'm getting 21,700. 21,700. That is the figure I'm getting from 𝐻𝐿. That is the figure I'm getting from 𝐻𝐿. That is the figure I'm getting from 𝐻𝐿. From 𝐻𝐿. Okay. So to this, we proceed, we add other incomes. We proceed, we add other incomes. So we need to go back to the trial balance. We see, do we have any other income? And remember, in this case, we said when checking for the other incomes, we check the items on the credit side of the trial balance. That's what you have to recall. So on the credit side of the trial balance, after I can see we have capital current, partners capital account, current account. Those are not incomes. Then down there, I can see we have sales. I can see we have bank balance, account payable. Down there, I can see we have accumulated depreciation. It basically means that in our case here, we don't have any other income. We don't have any other income. So we proceed. We get the total incomes, which remain the same as the gross profit. So then to this, we proceed. We less the expenses. We less the expenses. The expenses. Remember here we said when deducting the expenses, we always start with the expenses affected by the additional information. Affected by the additional information. Can we first of all go to the additional information? In the additional information, number 1 is all about the closing inventory. That is not an expense. Number 2, we have these two depreciations. We have depreciation on buildings. Depreciation on buildings, which is 250. We also have depreciation on furniture. Depreciation on furniture, which is 245. So 245. So I've written what? I've written, oh, this one should be, you have written 83 instead of 81. This one should be 81, 360. That's what I'm told by, yes, I think that one is correct. Okay, thank you, Purity. Okay, so let's move. We are done with additional information number 2. Additional information number 3, it affects 2 expenses. We are told the following expenses were owing, were not yet paid. So we start with the first one, which are salaries and wages. So salaries and wages, we will take the amount from the trial balance, the amount in the trial balance which was already paid, and the salaries and wages from the trial balance, that is an amount of 24. I hope you can see that figure down there. And then to this, I will add the amount which was owing. Amount owing is amount accrued. And remember, in this case, we have said when taking any figure from the additional information, you must omit the last 3 zeros. I'll take that figure as 200, not 200,000. So this will give me 26. So still in note number 3, we have electricity. For electricity, I'll take the amount we have in the trial balance, the amount which was paid and accounted for. And that, I think, is an amount of 500, should be 500. 500. And then I will add the amount not yet paid as per note number 3, the amount of 90. So that will give us a total of 590. So we are done with the note number 2. Note number 4, sorry, we are done with the note number 3. Note number 4, we have this increase in allowance for doubtful debt. This one 200. We have increase in allowance for doubtful debts, the amount of 200. That is an expense. Number 5, it is affecting insurance. It affects insurance. And basically, as per note number 5, we are told part of the insurance was prepaid, was paid in advance. So I will take the insurance we have within the trial balance. The insurance we have in the trial balance is an amount of 300. And basically, in this case, I will deduct the amount which was prepaid or paid in advance as per note number 5, which is 40. I will get to what? 260. So then from there, we have note number 6 is about drawings. Those drawings, they are not expenses. They are deducted here. So then from there, we can go back to the trial balance. We check the other expenses which you have not dealt with. And remember, you said when checking for the expenses, you check the items appearing in the debit column of the trial balance. So let's see whether we have the other expenses within the trial balance which you have not dealt with. So up there, we only check the items appearing on the debit column. I can see inventory, building, furniture, renovation. Renovation, we said, is not an expense. It is part of the building. It should be added to the cost of buildings. So then below that, we have purchases. We have dealt with that. Below that, we have rent and late. Have we dealt with the rent and late? No. So we have rent and rate. Basically, that will be our other expense, 400. Below that, we have electricity. We have already dealt with that. We have bank balance, account payable, yes, and then account receivable. Below that, we have repair and maintenance. That is basically the other expense, 1320. Below that, we have general expenses. General expenses, which is 47. Below that, we have insurance. We have already dealt with the insurance here. Carriage inwards, we have dealt with that here. Bad debt written off, we have not yet dealt with that. So we have bad debts, which were written off. And basically, that is an amount of 270. Salaries and wages, we have dealt with that here. Office expenses, we have not dealt with that. So that will be the other expense here. And that is an amount of 600. So then below that, we have, remember, I'm only interested with the items appearing on the debit column. I can see we have cash and we have what? We have the drawing. So meaning that we don't have any other expense. I hope we have considered all the expenses. Is there an expense you have skipped, which is given within the trial balance? I don't think so. I don't think so. So let's get the total expenses. We add all these expenses here. We have 250 plus 245 plus 2600 plus 590 plus 200 plus 260 plus 400 plus 1310, sorry, 1320 plus 4700 plus 270 plus 600. That is giving us 11,435. 435, and then we less that from our total incomes minus 21,700. And then in this case, we get the profit for the year. The profit for the year will be how much? Will be 10,265. 10,265. Is that what you're getting? 10,265. 10,265. Is that what you're getting? Is that what you're getting? Is that what you're getting? Yes. Juma, I've not seen any answer from Juma today. I hope you're together, Juma. Juma, tuko pamoja? I hope so. I hope so. So basically, I've said once we are done or we have gotten this one, the profit for the year, we proceed and prepare appropriation account. So to this, first of all, I've said we add interest on drawings. Interest on drawings. Is there any information we are given about this? Are the partners charged some interest on drawings? So that information has to be given in that, or it can only be part of the paragraph 1. Can we go back to paragraph 1? We see what we are told. We are told Maria and Bakari are in partnership, sharing profit and losses in the ratio of 3/5 for Maria and 2/5 for Bakari. The partnership did provide for the interest on capital at the rate of 5%. The partners are entitled to annual salary of 1,700,000 for Maria and Bakari. There is nowhere we are told the partners are charged interest on drawings. So meaning that we don't have any interest on drawings. And basically the amount which we get here, which is 10,265, this is the amount which is to be distributed to partners in form of salary, in form of share of profit, in form of what? Interest on capital and so on. So therefore to this, what we do, we proceed and we less the appropriations. To this, we proceed and we less the appropriations. So the appropriation in this question, we have how many? 3. We have salary to partners, we have interest on capital, and then we will have the share of profit or share of losses. So we start with we can start with the salary to partners. Salary to partners. Remember, you have 2 partners. We have Maria and basically Bakari. We have Maria and Bakari. And we are given their salaries. In paragraph 1, the last sentence, 1 million for Maria and Bakari, 700. So this 1 million we take, remember we omit the last 3 zeros. So it will be 1,700, 1,000 of shillings here. We get the total, we take it to the last column as a deduction. Basically, don't underline it. We will deduct that from this amount here. So then below that, we have interest on capital. Interest on capital. So we need to compute the interest on capital for each partner. For each partner. And this one is computed based on the partner's capital account balances. So we need to compute this one for Maria and basically for 𝐿𝐻𝐒. So as per the information we have in paragraph 1, we are told partners are entitled to interest on capital at the rate of 5%, not 10, 5%, 5%. So this should be 5% of what? This one should be 5% of the partner's capital account balances. The partner capital account balances, this is the first item you're given in the trial balance. The capital account balance for Maria is 12,000, and for 𝐿𝐻𝐒 is what? Is 5,000. So we get 5% of this, 5% of that. 5% of 12,000. This one will be 600. And this one will be what? Is it 250? Yes, 250. So we get the total. We take it to the last column as 850. As 850. The last appropriation here will be the share of profit or share of loss. How do we determine whether we have a share of profit or a share of loss? So what we do, we take the amount which we have here, we less this and this. So if you get a positive figure, is a profit to be shared. If you get a negative figure, is a loss to be shared. Automatically, in our case, we will have a positive figure. So which would be a share of profit. Which will be a share of a profit, a share of profit. So let's determine the amount to be shared as profit. And this profit will be shared between Maria and 𝐿𝐻𝐒. Maria and 𝐿𝐻𝐒. Remember, you're given the profit and loss sharing ratio in the first paragraph, which is 3/5 for Maria and 2/5 for 𝐿𝐻𝐒. So we multiply that with the amount to be shared. The amount to be shared, how much have you gotten? This minus those two appropriations, 10,265 minus 1,700 minus 850. So that is the amount I'm getting. That is the amount I'm getting. That is the amount I'm getting. Is that what you're getting? 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 Yes, that is confirmed by Esther Eunice. And I've not seen any answer today from Nicole. Is Nicole here? I'm a reporter. Nicole, I've not seen any answer from you today. I've not seen any answer from you. I hope you're together. I hope we are together. Okay. I've not seen any answer from you today. So let's get the amount to be shared here. The amount to be shared. Paul, you're getting what? Paul, I think your answer is wrong. Please confirm. Please confirm. Reconfirm your answer. So we get the amount to be shared. 7715 divided by 5 times 3, which will give us 46, 29, and 30, 86. So that is basically what I'm getting. And the total amount, we take it to the last column. We take it to the last column. Then once we take this, minus this, minus this, minus that should be 0. That should be 0 because this amount has been distributed to partners in form of salary, in form of interest on capital, in form of salary. In form of salary. Paul, what are you getting? What are you saying? 5% of what? Where are you getting 1,200? This one is 12,000, Paul. This one is 12,000. The first item within the trial balance is not 1,200. should be 12,000. Yes, so basically that is it. That what is required in part A of that question. Basically, by doing that, the marks allocated here are basically 12 marks. So the marks allocated there were 12 what? 12 marks, 12 marks. So now I want us to move to part B, but even before you do that, here, no, Erin is asking, do partners pay profit? No, partnership business, this is something we'll be able to discuss in details in a unit called PFT, Public Finance and Taxation. A partnership business is not recognized as a legal entity. Partnership is not recognized as a legal entity like a company. A company is recognized as a legal entity. That's why we say a company has to pay tax. So what happens is that this profit, which is reported by partnership, is distributed to partners. Now, it is the partners themselves who are taxed. If you are a partner, you are the one to pay tax to the government based on the amount you have gotten from the partnership business. But the partnership business itself is not a legal entity. It should not pay tax to the government. Salsa? Yes. So basically, that is the position. Partnership business is not a legal entity, is not required to pay tax to the government. The partners themselves are the one who pay the tax, and that is something you'll be able to cover in tax in a unit called PFT. You'll be able to see how do we compute the tax to be paid by each partner here. Now, I'm saying before you prepare what is required in part B, there is something which the examiner will not tell you, but you have to prepare the partner's current account even before you proceed to prepare the statement of financial position. Remember, you have said the balance in the capital account will not change unless there was additional capital. So the balance in the partner's capital account will not change. What will change is the current account balances, because all these items here will affect the current account. So we must prepare the current account, and then finally we prepare the statement of financial position. So let's first of all, we prepare the current account, and then we prepare what is required in part B of that question. So we prepare the partner's current account, a partner's current account, so remember, in this case, we have two partners. We just need to have the details column. And basically, columns equal to the number of partners who are basically 2. So remember, this basically ledger account. We must split this into 2. So this will be the details. And then we have Maria. We have Bakari. Details. Maria. And who? And Bakari. And Bakari. So what do we start with here? We always start by recording the opening balances from the trial balance. So let's go back to the trial balance. We pick the balances which are given there. And in that case, we have said you have to be very, very keen. You check whether those balances given in the trial balance, are they debit or credit? So, and those balances, that should be our second item within the trial balance. Below the capital account, we have the current account. And I hope you can see those current accounts. The current account for Maria and Bakari, both, or basically those accounts had credit balances. Credit balances simply because those particular balances are on the credit side. The last column of the trial balance, which is basically a credit balance. So the balance brought down for Maria is 3,000. And then for Bakari is what? Is 1,000. Then you have to record, what do we then record here? On this side, I've said we record all appropriations. All these appropriations, we record them on this side, unless we have a share of loss. If we have a share of loss, that should come to this side. So we have salary to partners, which is 1,000 and basically 700. We have the interest on capital, which is 600 and 250. We have the share of profit, which is 46.29 and 30.86, like that. So all those appropriations should be credited here, unless we have a share of loss. So on this side, then we have drawings. The drawings, we will take the drawings which are given in the trial balance, and the drawings, that should be the last item within the trial balance. But remember, the drawings for goods which are given in the additional information number 6. The drawings for goods given in the additional information number 6, we see those drawings have not been accounted for. Other than deducting them from the goods available for sale, we will also add them to the drawings given within the trial balance. So the total drawings for Maria will be the amount given in the trial balance 28 plus the drawings in note number 6 for Maria. So it is 28 plus 150, 2,800 plus 150, which will give us 2,950. That is for Maria. For Bakari, the drawings given in the trial balance 2,000 plus the ones which are given in note number 6, which is 590. So that will give us 2,590. Yes. So the other item, which is also recorded on this side, and basically in this question we don't have it, is the interest on drawings. So the other item which is also recorded on this side is the share of loss. So we don't have share of loss. So basically having that, then what do we need to do? We need to balance this account. This account here. This account. And remember this basically ledger account. This is a ledger account. So to balance this, we use the same concept we were using in balancing the ledger account. Only that here we have two current account for Maria and for Bakari. So we have to balance for Maria. We get the total on this side, which is 2,950 for Maria first of all, and then we get the total on this side for Maria. Yes. So the total on this side for Maria, this one will be 4,046. 46 plus what we have here, 46.29. So the total on this side is 92.29. So what do we record here in the totals? The amount which is more, which is this one. And we record it on both sides. 92.29, 92.29. So we know that if you add all this, it will give us that amount. But if we add all this, will it give us this amount? No. So it will give us this. So what is the difference? The difference we record it here as a balance carried down. So this minus this one. So which is 62.79. So we do the same for Bakari. Get the total on this side. These drawings are correct. Or the drawings for the two partners are actually the same. These are, oh, sorry, they are not the same. They are this 2,950, this 2,590. Okay, it's okay. So this will give us 2,590. What about the total on this side? This will be 17 plus 250 plus 30.86. 86, this one. So that will give us 50.36. So the total which is more is this one, 50.36. 50.36. We record it there and here. We know this will give us that, but this will not give us this. So what is the difference between these two values? 25.90. 24.46. 24.46. Is that what you're getting? Yes. That is basically what you're getting. Yes. So now I wanted we wind up. let's wind up by preparing what is required in part B, the statement of financial position as at a statement of financial position as at 30th of April 2016. 30th of April 2016. 30th of April 2016. 30th of April 2016. So here, we just need to have a single column. And what do we start with? We start with the non-current assets. We start with the non-current asset here. Non-current assets. So for the non-current assets, basically we have a number of them. We have a number of them. The first non-current asset is which one? Purity. Is which one the first non-current asset? The first non-current asset is which one? Purity. Yes, I'm told by Zuma. I'm told by Zuma is what? Is buildings. So buildings. So for buildings, remember, we will take the cost of buildings, which is 85, but also to this, we said we add the cost of renovation. The renovation cost is also added here. Is also added here. Sasa? Yes. So we also add the renovation cost here. And then remember, you say to compute the net book value of the asset at the end, we should less the accumulated depreciation at the start. If you check on the information given in the trial balance, there was no accumulated depreciation for buildings at the start. No accumulated depreciation for buildings at the start. So to this, we will only deduct the depreciation for the current year, which we computed here, which is 250. So we don't have any depreciation, accumulated depreciation at the start. This will be 10,000 minus this one, which will give us 97.50. So below buildings, we have furniture. We have furniture. So we take the cost, which is 32. We left the accumulated depreciation at the start. I hope you can see that almost at the bottom of the trial balance, the provision for depreciation, 750. And then we also left the depreciation for the current year, this one, which will give us, which is 245, which is 245. That will give us what? I'm told that will give us 2205. 2205. Okay. So below furniture, or in this case, do we have any other non-current asset? Any other non-current asset? I can't see any. We have any other? No. So we move and record the current assets. The current assets. So for the current assets, I think we can first of all pick what we have in the additional information. In the additional information number 1, what do we have? In the additional information number 1, we have the closing inventory. We have the closing inventory in the additional information number 1, which is 15,600. Then below number 2, we have the depreciation. That has nothing to do with this. Note number 3 is expenses which were accrued. That will be current liability. Number 4, allowance for doubtful debts. That will affect the account receivables or the trade receivables. So in the trial balance, we have account receivables. So the account receivables in the trial balance is an amount of 5660. And then to this, we said we always less the allowance for doubtful debts at the end, which is 200, which will give us 50 forward 60. So number 5, we have insurance paid in advance. Any prepaid expense is basically a current asset. Insurance paid in advance. So the insurance paid in advance is basically 40. So then note number 6, that is not a current asset. So we go back to the trial balance, and remember, when checking for asset, we check the items appearing on the debit column. So can we check whether we have any other current asset? Maybe we can start with the last item in the trial balance. We have drawings, basically, which is not an asset, but above that we have the cash balance. The cash balance is an asset, which is 230. And then above that, we have office salary, budget written off, carriage in what? Insurance, general expenses, repair and maintenance, account receivable. We have already dealt with that one. Then up there, you can see we have electricity, rent and late purchases, renovation, furniture, buildings. Yes. So in our case, we don't have any other current assets. So what we need to do is we get the total assets. We get the total assets. Give me the total assets. Give me the total assets. Give me the total assets. The total assets. The total assets. Just a minute. Okay, so let's finish on this. Maybe I hope you have already done. You already have the final figure. So I'm told this one will be 33 to 85. So then with the borderline start, we proceed. In this case, I've said in case of partnership. So we start by recording the partners' capital account balances. So partners' capital account balances. And basically, these balances is what we have in the trial balance, the first item. In the trial balance, the first item, we are given the partners' capital account balances for Maria and basically for Bakari. And those balances, we have said, in this case, they are not changing. But I've said, for those who are doing admission, retirement, you'll be able to see that we have some adjustment which we make in the partners' capital account. So this one is 12,000. And then for Bakari is 5,000. Then from there, we record the partners' current account balances. Partners' current account balances. And the balances which we record here for the current account are not the ones which we have in the trial balance, are these closing balances. That's why he said, even before you prepare this one, you must prepare this account because you need to get the new balances. The new what? Balances. In this case, it's also important for you to determine these particular balances here. Are they debit or the credit? Are they debit or credit balances? Now, who can tell me these balances for the current account, are they debit or are they credit? So the balances from the partners current account, are these debit or credit balances? Eunice, Purity, Rin, or are these debit or credit balances? Yes, remember when we were looking on the topic of ledger account, I said if you get such a question, you give the balance brought down. So remember in this case, the balance brought down should be on this side, should be on that what side. So these are credit balances. So if they are credit balances, you record them here as positives. If they are debit balances, you record them here as a negative. So these are credit balances for Maria. And basically for who? For Bakari. So we have 62.79. We have 24.46. Yes. So then from there we proceed and record liabilities. We start with the non-current liabilities. Non-current liabilities. Non-current liabilities. So for the non-current liabilities, I don't think we have any because we said in a partnership business and also in sole proprietorship, Non-current liabilities may only take the form of a bank loan. We don't have a bank loan here. Finally, we record the current liabilities. We record the current liabilities. The current liabilities. The current liabilities, we have a number of them. Maybe we go to the additional information first of all. In the additional information number 3, we have some accrued expenses. We have accrued salaries and wages, accrued salaries and wages, and also we have accrued electricity. Any expense not yet paid, we say it is a current liability. Other than being added to the expenses already paid, we also account for them as current liabilities. We have 200, and then we have 90. Then number 4 is allowance. Number 5, we have dealt with that. Number 6, we have dealt with that. So we go back to the trial balance, and basically remember all liabilities, they have a credit balance. Check the items appearing on the last column. So up there we have the capital, the current, and then down there I can see we have sales. Then I can see we have bank balance. Can you see the bank balance of 1070 on the credit side? So which name is given to that amount? That bank balance of 1070, which is on the credit side. Yes, this one I can see, Eunice, you can be able to remember that. We say that this one is known as a bank overdraft. Is known as a bank overdraft. But we say the examiner will not tell you. He will just give you that balance, but he give that balance he recorded on the credit side is a bank overdraft. So 1070, and then below that we have the account payables. Account payables is the 62, and then down there I can see we have a provision for depreciation. So basically in our case we are done. So what we need to do here is we get total capital and liabilities. Total capital and liabilities, we add all this. We add all that. We see whether it will give us the same amount there. Will it give us the same amount? Yes, I'm told by Zuma it will give us the same amount, 33, 285, 285, 285, 285. Yes, so it's basically coming to the same amount. So that's basically how we prepare the financial statements, or basically the final account of a partnership. But basically I've said that if you check on those particular questions specifically tested in CPA and ATD2, you'll be able to see that most of the questions do not examine on this. There are questions having the aspect of admission of a new partner, a retirement of a new partner, or even a question for a dissolution of partnership. So mean that for those who are doing ATD, and also for those who are doing ATD2 and CPA, we will be able to proceed and look on how do we account for admission of a new partner, how do we account for retirement of a partner, how do we account for admission. But basically for those who are doing ATD1 and CAMS, I'll be able to give you more work on this, more assignments on this. So mean that you'll not be required to attend like the next two classes, but I'll be able to see whether I'll be able to give you an extra class for those who are doing CPA and ATD2, because preferably I want us to finish on this topic this week. So if we can be able to get like 2 classes, we should be able to finish. 2 or 3 classes I'll be able to see. We should be able to finish with this, so that now we can be able to proceed to another topic. And also what is insisted on as far as financial accounting is concerned, you need to do a lot of exercise. A lot of exercise. Once we are done with a certain topic, try to go through the past papers and you see, are there some other questions which you can be able to attempt? Because you can only become perfect in this paper here, financial accounting, by doing a lot of exercise, by practicing a lot. Sasa? Yes, yes. So for today, therefore, I want us to stop on at that point and be able to communicate maybe with those who are doing ATD2 and basically CPA. We see whether we can be able to create maybe one additional class in course of the week, so that we can be able to discuss the remaining aspect. But I've said those who are doing ATD1 and basically comes Akina Esther, I'll be able to give you more work on this. You're not required to cover the aspect of retirement, admission, and dissolution. So I think, Rin, can you remind me tomorrow whether we can be able to create time so that we can have an extra class? Rin, Sasa? Yes. So let's stop at that point for today. We continue from there in our next session. So have a good night. I want us we continue with the topic of public financial statements. Specifically today, I want us to look on an illustration, and I want us to start with this question for August of 20. You'll be able to see that those figures are in thousands of shillings. So therefore, for us to be consistent, we must work with all our figures in thousands of shillings. In any of the figure we have from the additional information, we must omit the last three zeros. We must omit the last three zeros. Yes, we must omit the last three zeros, the last three zeros. Yes, I'm trying to make some changes on my camera here. I don't think it is that clear, but it should be now. It should be now. It should be clear now. Should be clear. Should be clear. Yes, it should be clear. Should be clear. Okay. So therefore, what you have said is that this particular amount, we will deduct it from the revenue. Number two, anytime the company sells an asset, disposes an asset, you must compute whether the asset was. You must determine whether the asset was sold at a gain or at a loss. And actually, we do that by preparing an account which is called the disposal account. So therefore, what we need to do is basically to prepare the disposal account, and we determine whether this asset was disposed at a gain or at a loss. Although in this case, let's not use the disposal account. Let's not use this account. Let's just compute this directly. To compute the gain, or basically the loss on disposal of an asset, we take the sales proceeds. The sales proceeds, our asset was sold at how much? And then we deduct the net book value, which is the same with the carrying amount. We know that the net book value of an asset, this one is equal to the cost minus the accumulated depreciation. So if you get, after taking this minus this, if you get a positive figure is a gain, but if you get a negative figure here, if you get a negative figure is what? Is a loss. So therefore, let's compute this. We will take the sales proceeds, and basically the sales proceeds is this particular amount at which our asset was sold at, 20 million. And then to that, we proceed and we less the net book value. So the net book value, we are saying, is the cost minus accumulated depreciation. If you check on the information we have in paragraph, in note number one, sentence 2, we are told no accounting entries was made. The plant had a cost. We are given the cost. I want us to compute this one. We take the cost, which is 39,700,000. That was the cost, and accumulated depreciation of 15,860,000. So this now will give us the net book value. So therefore, we take 20,000 minus this net book value. So how much would be our net book value here? How much would be our net book value? The net book value for this item So that would be 39,700 minus 15,860. 860. So what are you getting? I'm getting a figure of 23,840. Is that what you're getting? Lucia, Helen, is that what you're getting? Hassan, Virginia, Raphael, is that what you're getting? Yes. So it basically means that this particular asset here was sold then at a loss, because if we take this minus this, we will get negative what? We'll get negative 3840, which basically is the loss on disposal. So being a loss on disposal, this one will be included within the cost of sales. Within the cost of sales, it will be added to the cost of sales. It will be added to the cost of sales. So I think those is what is required. One, we have said this amount of 20 million, which was included within the sale. We will less that from the sales. Also, in this case, we have computed the loss on disposal, which you have said will be added to the cost of sales. So let's move to note number 2. And you're told the depreciation on property, plant, and equipment is to be provided and allocated as follows. So we are given the 4 assets: buildings, plant, motor vehicle, office equipment. We are given the rate for computing the depreciation, the basis of computing the depreciation, and how that depreciation will be classified. So let's compute those particular depreciations for the current year. That should be our working number 2, depreciation. So we start by computing the depreciation on buildings. Depreciation on buildings. In this case, we are told this will be 2.5%. Using which method? Using the straight line. So you have to recall, under the straight line method, we compute the depreciation based on cost. Under the reducing balance method, we compute depreciation based on the net book value. So therefore, for building, we will take 2.5% of the cost. What is the cost of the buildings? The cost of the buildings, this one, you should get it in the trial balance. The first item within the trial balance, we have property. And property we know comprises of land and building. This is something I said in our previous class. Property comprises of land and building. So in this case, we are told the cost of buildings is 400 million. It automatically means that because the total cost of the property is 600 million, the cost of land is 200 million. But in our case, we're interested with this. We're interested with the cost of the building. So the cost of the building, in this case, is 400,000. Remember, we are working with all our figures in thousands of shillings. In any figure, we are omitting the last 3 zeros. So let's get 2.5% of that. 2.5% of this will give us what? 2.5% of this. What are you getting? What are you getting here? Are you getting 10,000? Yes, 10,000. That is the figure I'm getting from Helen. That is a figure I'm getting from Lucia. Okay. So then from there, basically, even before we proceed to compute the other depreciation, we are told that this depreciation here of 10,000, this one would be classified as part of the administrative expenses. So let's move and compute the depreciation on plant, which will be 10%. 10%. Which method is used here? The reducing balance method. So under the reducing balance method, we compute depreciation based on the net book value, So we need to compute the net book value of the plant. How do we compute the net book value? So we will take the cost, because this one is equal to the cost minus the accumulated depreciation. So therefore, the net book value of the plant will be equal to the cost. The cost is given in the trial balance. Can you see the cost? The cost is the second item within the trial balance, which is 280,000 minus the accumulated depreciation, which is down there. The accumulated depreciation, who can be able to see the accumulated depreciation on plant? It is 111, 111, 160. 111, 160. So this will give us what? 280,000 minus 111, 160. And what are you getting here? Yes, I'm getting a figure of 168,840. Is that what you're getting? Is that what you're getting? Please confirm. Hassan, are you getting this? Noor, are you getting this? Is that what you're getting? Is that what you're getting? Is that what you're getting? Please confirm so that we move. Is that what you're getting? Yes. So we have 168,840, 168,840. But now you have to remember, in the additional information number 1, there was a plant which was disposed. Can you remember this plant which was disposed? I want us to go back to note number 1. We see what we are told. Specifically, the last sentence of note 1. In the last sentence of note 1, we are told it is the company's policy to provide for the full year depreciation in the year of the asset purchase. What does that mean? It basically means that once the company has purchased an asset in a given year, the company will provide a full year depreciation. Even if the asset is bought 2 months, 1 month, or even 3 months to the end of the year, the company provides a full year depreciation. That's what you're told, and none in the year of disposal, and none in the year of disposal. So if an asset is purchased in course of the year, no depreciation for that asset. And therefore, I hope you can be able to recall, during the current financial year, the company disposed this plant. And we are told whenever an asset has been disposed in a year, no depreciation to be provided in that year. So this net book value here comprises the net book value of this plant which was disposed. So what we need to do, before we compute the depreciation, we need to eliminate the net book value of this plant which was disposed. The net book value of this plant which was disposed is basically what we have computed here. Remember the net book value. This is the net book value of the plant which was disposed. So therefore, we left it here. We left 23,840. So why are we doing that? Because as per note number 1, the last sentence, we are told no depreciation in the year of the asset disposal. So if an asset is disposed in course of a certain year, no depreciation to be provided in that year. Sasa? Yes. So this now will give us what? We take this one minus this, minus 23,840, which will give us 145,000, and then we get 10% of that. So 10% of that will give us what? Will give us 14,500. And then this depreciation here then will be classified as part of the cost of sales. Will be classified as part of the cost of sales. Will be classified as part of the cost of sales. Will be classified as part of the cost of sales. Is that point clear? Have we understood why we have done that? Zipporah, Lucia, Helen, Noor. Is that point clear? Is that point well understood? If it is well understood, let's move and compute the depreciation for the other asset. So we are still in note number 2. Let's compute the depreciation on motor vehicles. Motor vehicles, which is equal to 20% of what? 20% on street train. Street train, we compute the depreciation based on the cost. What is the cost of motor vehicles? Motor vehicles, basically this is that item within the trial balance, which is 70,000, and this will give us 14,000. So how should this depreciation be classified? As per note number 2, this one will be considered as part of the distribution costs. So we also compute the depreciation as per note number 2 on office equipment, which will be 12.5%. 12.5% of the costs, because the method to be used there is the street train. So the office equipment, the cost for that is 40,000. 40,000. So what would be 12.5% of this? 12.5% of this. This will give us what? Is it 5,000? 5,000. Yes, 5,000. And basically this one still will be part of the administrative expenses, part of the administrative expenses. So we are done with that point. We are done with that point. I want us now we move to point number 3. In point number 3, we are told it is discovered that the former financial controller of BD Limited engaged in fraudulent financial reporting of shillings 12 million of the trade receivables. Okay, let's take that point again. We are told it has been discovered that the former financial controller of BD Limited engaged in fraudulent financial reporting. Shillings 12 million of the trade receivables are non-existent and need to be written off. Of this amount, 7 million relates to the year which ended 31st of December 2022, which is now the current year, while the balance or with the balance relating to the prior period. So basically, we are told in that point, the former financial controller of this company was involved in fraudulent financial reporting. Fraudulent financial reporting, in very simple terms, we refer to this as cooking the books of account. If, for example, as an accountant, you want to show the company is financially stable, you may overstate the assets. You may overstate the asset, or basically you can overstate the revenue. So that's what the financial controller did. So within the trade receivables, he included 12 million, which is non-existent. So no debtors who owe the company an amount of 12 million. And we are told this amount has to be written off. That amount has to be written off. So the working 3 here will be the trade receivables. The trade receivables, which are to be written off. So the trade receivables to be written off basically is an amount of 12 million. So we are told 7 million of these related to the current year. And basically this one will be treated as an expense, will be recognized as an expense within the current year. Remember, what we said is that when preparing a statement of profit or loss for publication purpose, we classify the expenses into 5. Now, this particular amount which was written off, we have to determine it will be classified as part of which expenses. Is it part of the cost of sales? Is it part of the distribution, admin, finance, or other expenses? Now, because this particular amount has been written off as a result of a decision made by the management of the company, this one we included within the administrative expenses. It is an amount which has been written off as a result of administrative decision, as a result of decision made by the management. So this one will be added within the administrative expenses. And then the other amount, which is 5,000, which relate to the previous year, this one will be adjusted in the retained earnings, when preparing the statement of changes in equity. Statement of changes in what? In equity. If you can be able to recall in our previous class, I gave you the format for preparing this statement of changes in equity. We said any prior year adjustment. These are adjustments which were supposed to be done in the previous year, but they were not done. They should be adjusted to the retained earnings at the start. Because this was this amount of 5 million was supposed to be recognized or was supposed to be accounted for by the company as an expense in the previous year, but it was not accounted for. So this one we will deduct it from the retained earnings of the company at the start. This one we treat it as an administrative expense, and then the full amount, this one of 12, this one automatically will be deducted from the trade receivables. The trade receivables of the company will be reduced with what? Will be reduced with the 12 million. So that is the adjustment which is required for that amount. So let's move to the other note. Let's move to the other note. We move to the other note, we see what we are told. Note number 4. Note number 4 is all about IAS 12, income taxes, and we are told the existing debit balance on the current tax in the trial balance represent over provision for previous year's tax. Can we first of all go back to the trial balance? In the trial balance, I can see we have something called the current tax. Can you see the current tax? And actually, we are told that that current tax is the debit balance. So how much is the current tax in the trial balance? The current tax in the trial balance is how much? Current tax in the trial balance Current tax in the trial balance, can you see that? Current tax in the trial balance. Yes, so I'm told that current tax in the trial balance is an amount of 2,600. 2,600. Now, take into account this amount in the trial balance, it appears on the debit column. What is this? Is it over or under provision? What is this? Based on our previous discussion, is it under or over provision of tax? Over or under? I'm told by Zipporah it is under, by Lucia it is under. Yes, automatically this one is under provision. Is under provision. We said if that amount appear on the debit column of the trial balance, it is under provision. If it is appearing on the credit side, we say is what? Is over provision. We say such under provision in the previous year should be brought to the current financial year and should be added to the current year's estimated tax liability. So in the other sentence of note number 4, we are told a provision for current tax for the year which ended 31st of December 2022 over 52 million is required together with a decrease